the Bank of Japan is on the verge of a pivotal shift, one that could reshape capital flows across Asia and send shockwaves through global markets. After years of anchoring policy to ultra-low rates, the BOJ is now widely expected to raise its benchmark interest rate to 1% in June, marking the most aggressive phase of its normalization cycle since exiting negative rates in 2024. This isn't just another incremental move. It's a signal that Japan's long-dormant monetary policy is finally waking up to inflation and wage growth that demand a response. According to a Reuters poll of 34 economists, 28 forecast a rate increase at the June 15-16 policy meeting, lifting the BOJ policy rate from its current 0.75% to 1%. That would be the highest level since 2008, and a clear break from the decades of accommodative policy that defined Japan's economic landscape. The remaining 6 economists expect the move to slip into the third quarter, but even they agree that tightening is inevitable. Most people arrive after the move is obvious and the easy upside is gone. We focus on serious crypto education and high-quality signals before the crowd rushes in, so you can understand the setup earlier and move sooner. If you want that edge, visit the link below now. What makes this shift more significant is the expectation of a follow-up hike in the fourth quarter, potentially pushing the rate to 1.25% by year-end. This trajectory reflects growing confidence within the central bank that Japan's economy can absorb higher borrowing costs without derailing growth. The mechanism behind this pivot lies in 2 key indicators: inflation and labor. Core consumer inflation, excluding fresh food, is holding around 2.5%, above the BOJ's 2% target, and wage growth is proving resilient, giving policymakers the green light to act. The impact of BOJ rate hike expectations is already rippling through financial markets. The yen, which has languished near multi-decade lows against the US dollar, is poised to strengthen as higher yields make yen-denominated assets more attractive. A stronger yen could lower import costs for Japan, helping to moderate inflation, but it also threatens export competitiveness, a critical vulnerability for an economy driven by manufacturing and overseas sales. Japanese government bond yields are also likely to rise, testing the BOJ's continued control over the yield curve and potentially affecting long-term borrowing costs for public and private sectors alike. The important part is not just that the BOJ raises rates, but that it's doing so amid mounting global uncertainty. Trade tensions, financial market volatility, and shifting monetary policies in the US and Europe are all wild cards. The BOJ has emphasized that its decisions remain data-dependent, leaving room to pause if external shocks disrupt the domestic recovery. That makes the June meeting not just a policy decision, but a test of confidence in Japan's ability to stand on its own. Most people arrive after the move is obvious and the easy upside is gone. We focus on serious crypto education and high-quality signals before the crowd rushes in, so you can understand the setup earlier and move sooner. If you want that edge, visit the link below now. Looking ahead, the most critical signal will be the language in the BOJ's post-meeting statement in June. Will Governor Ueda reaffirm a gradual but steady pace, or will he leave the door open for flexibility? The wording around inflation forecasts, labor market strength, and global risks will determine whether the yen continues to rally or if markets begin to doubt the sustainability of the normalization cycle. The BOJ and yen relationship is entering a new phase, one where policy credibility is on the line. A final BOJ rate hike by year-end depends on more than just domestic data. It hinges on whether the global backdrop remains stable enough to allow Japan to decouple from external turbulence.